Hello and welcome to the Business Standard Morning Show. I'm Kanishka Gupta and let's have a look at the stories for the day. US technology giant Oracle has been accused of bribing government officials in India, Turkey, and UAE to grab business contracts. Charged with violating America's Foreign Corrupt Practices Act, the company is paying $23 million as penalties to settle the case. In 2012, too, Oracle was accused of bribing Indian officials and had to settle the matter in the US. Walmart and Cognizant too have faced similar allegations. While multinationals are held accountable and pay for such violations in the US, does the same happen in India? Let's find out.
US business software maker Oracle on Wednesday agreed to pay $23 million to the Securities and Exchange Commission to settle charges that it violated the Foreign Corrupt Practices Act or FCPA between 2014 to 2019. During this period, its subsidiaries in India, UAE, and Turkey allegedly created and used slush funds to bribe foreign officials. In India, the American markets regulator alleged that Oracle paid bribes to officials of a transportation company owned by the Ministry of Railways. Oracle did not admit or deny wrongdoing in agreeing to settle. This is not the first time that Oracle has been charged with violating the US anti-bribery law over India-related payments. In 2012, it agreed to pay a $2 million fine to settle SEC charges concerning the creation of millions of dollars of unauthorized side funds by Oracle India from 2005 to 2007. The Indian unit allegedly set aside money outside its books that was eventually used to make unauthorized payments to phony vendors, creating a risk that those funds could be used for illicit purposes such as bribery. Several multinationals have time and again fallen afoul of the FCPA, including retail giant Walmart, medical device company Stryker, advertising group WPP, aerospace manufacturer Embraer, IT services company Cognizant, spirits companies Beam Suntory, Ab InBev, and Diageo, locomotive developer Wabtec, and Cadbury owner Mondelez International. Enacted in 1977 and enforced by SEC and US Department of Justice, the Foreign Corrupt Practices Act or FCPA prohibits the payments of bribes to foreign officials to assist in obtaining or retaining business. It extends to US listed companies and their officers, directors, employees, stockholders, and agents, including third-party agents, consultants, distributors, joint venture partners, and others. It also contains accounting provisions that prohibit individuals and businesses from knowingly falsifying books and records or circumventing or failing to implement a system of internal controls. Regardless of size, for a gift or other payment to violate the statute, the payer must have corrupt intent. The FCPA Resource Guide states that bribes are often concealed under the guise of legitimate payments such as consulting fees, commissions, marketing expenses, scientific incentives, travel and entertainment expenses, and discounts, among others. Kunal Gupta, an expert in white-collar crime law, tells us why Indian agencies seldom take up such cases.
These settlements are in the public domain and they are fairly explicit in terms of details in terms of the conduct, the timing when they've happened, the amounts, etc. They are being evaluated from the US law perspective, and therefore the standard that is being used is the US legal standard, and the liability is also the US legal liability. Most of these matters are actually settlements that usually occur as a result of companies deciding to do a self-disclosure. And there are very detailed guidelines in terms of the credit that the companies can expect, and they're incentivized to do such a self-disclosure. We don't see such conduct being sort of lapped up by the Indian agencies is because A, the legal standard is different, and B, these matters have not been tested in a court. Companies in their own wisdom obviously decide and find it useful to settle. The legal standard that we're talking about is different. So you have situations, for example, where companies, where SEC, for example, is interested in the books and records provisions of FCPA. And that does not necessarily mean that you need to have a public official on the other side of the transaction. And if I were to test that only from the Prevention of Corruption Act perspective, right, it will not be sufficient to do a prosecution under Indian law.
Walmart's $282 million payment in 2019 was one of the biggest FCPA settlements involving India-related charges. US authorities said Walmart's failure to operate a sufficient anti-corruption compliance program led its subsidiaries in Mexico, India, Brazil, and China to hire third-party intermediaries and allow these middlemen to make improper payments to government officials to obtain store permits and licenses. In 2019, Cognizant Technology Solutions agreed to pay $25 million to SEC to resolve allegations that it authorized a contractor to pay a $2 million bribe to a senior government official in Tamil Nadu in 2014 to secure planning permits for the construction of its 2.7 million square foot campus in Chennai. Brazilian plane maker Embraer's $206 million settlement in 2016 to resolve charges of corruption in 4 foreign contracts is an instance where SEC action has led to investigations in India. Approximately $5.76 million was allegedly paid to an agent in India in connection with the sale of 3 highly specialized military aircraft to the Indian Air Force for $208 million. The payments were falsely recorded in Embraer's books and records as part of a consulting agreement that wasn't legitimate. India's Central Bureau of Investigation is probing the bribery allegations.
All the elements of the offense that are in India, it has to be tested against Indian law. Under Indian criminal law, at least you'll have to prove mens rea in addition to the act that would have happened, right? So the intent element of that is extremely important. That can lead to the agencies taking cognizance by themselves, suo motu. If, let's say, we take a situation where there is a whistleblower situation that has happened, right? And that has led to a books and records issue, not necessarily involving any public official. Now, the company may, as if it is an SEC registrant with facilities and with presence in India, the company may report back to SEC. Obviously, they will report that to auditors. There may not be an obligation to report that to the agencies. There is one provision that requires companies to report, but that may not be attractive depending upon the offense that is made out. As a result of that, even though there may be a settlement at the US level, it may not necessarily lead to any sort of a cognizance being taken.
While Indian agencies have the option to collaborate with American authorities when such violations occur, we must remember that very few of them end up in court, even in the US. Moreover, the conduct under the scanner of US agencies may not amount to a crime under Indian law. Since the Prevention of Corruption Act 1988 criminalizes bribery of public servants, Indian agencies would be able to pursue action if they can establish that such officials were involved and identify them. This makes legal action difficult, even though enough information is available from US agencies.
Multinationals Amazon and Walmart, which owns Flipkart, are up for a stiff competition. Reliance Jio is also upping its game, trying hard to catch up with the two giants. Ahead of festival season, it is offering a one-step solution for all shopping needs, from electronics and consumer durables to fashion, lifestyle and grocery. This ambitious digital push raises a crucial question. Can Reliance repeat its brick-and-mortar success in e-commerce? Let's find out.
Reliance Retail, the country's largest retailer, has said that during the April-June quarter, it recorded 175 million footfalls, which was 19% above pre-COVID levels, and opened 792 stores. Overall, the retailer has 15,866 operational physical stores, and the footfalls reflected in the profit too. Reliance Retail clocked a 114% jump in its net profit at 2,061 crore rupees for the April-June quarter compared to last year. The company also said that it had delivered its best ever quarterly gross revenue at 58,554 crore rupees, up 51.9% year-on-year. The retailer's business grew 5 times over the last year when it comes to luxury and premium brands. This growth was driven by fully operational mall stores and in-store events. Clearly, the brick and mortar segment's performance played a major role in Reliance Retail's success. So, can it repeat that success in the e-commerce space too? US-based research group Bernstein estimates that Walmart-owned Flipkart was leading the Indian e-commerce market with annual sales of $23 billion in 2021. Amazon was the second biggest player with between $18 to $20 billion of gross merchandise value or GMV last year. Reliance came next with e-commerce sales of around $4.6 billion. GMV is the value of all the goods sold on a platform. However, Amazon has more sellers at 700,000 compared to Flipkart's 450,000 and JioMart's 300,000. Reliance's competitors also have a wider selection. Amazon has nearly 170 million products across more than 100 categories, while Flipkart has over 150 million products across 80 categories. Reliance certainly has ambitious plans in this space. JioMart, Reliance Retail's digital commerce platform, is morphing into an e-marketplace where multiple brands spanning electronics, consumer durables, fashion and lifestyle, beauty, home, kitchen, and grocery will now be offered. In pursuit of this goal, the company has been onboarding third-party sellers for the past few months, further increasing its offerings across categories. In August, Facebook parent Meta and Jio Platforms also announced the launch of the first ever shopping experience on WhatsApp. Reliance Retail said that this was a global first, adding that JioMart on WhatsApp would enable users, including those who had never shopped online before, to browse through JioMart's entire grocery catalog, add products to the cart, and complete the purchase by making the payment, all without leaving their WhatsApp chat. Reliance Retail is also foraying into the fast-moving consumer goods or FMCG space. It is taking its private label brands to general trade. Here too, the digital platform will play a key role. Daulat Capital VP Sachin Bobade told Business Standard that because of its own distribution through JioMart, Reliance Retail had consumer information. This would make it easier for the company to launch its products and gauge the demand for them. There are various strategies Reliance can and may deploy to take on the e-commerce giants. According to Bernstein, Reliance already leads in the e-grocery and online to offline categories with its 15,000 store retail footprint and a strong inventory-led model. Reliance Retail is also rapidly increasing the categories in which it has offerings through acquisitions. It has bought online pharmacy NetMeds and online furniture retailer Urban Ladder. It has also acquired digital lingerie seller Zivame and online grocer Milk Basket. Adding to that, Reliance Retail is reportedly in advanced talks to get the rights for beauty retailer Sephora in India. There is also a lot of premium on the first mover advantage in the e-commerce sector. Overcoming this disadvantage will require the successful implementation of Reliance's Retail Plus strategy, wherein Indians will shop in its physical stores or on JioMart, use its mobile and Wi-Fi networks, get their entertainment over JioCinema, and pay for all of it using JioMoney. If it can ensure that the consumer never leaves this Jio bubble, competing with the likes of Amazon and Flipkart on an equal footing may very well be possible. But even after all of this, the factor that could ultimately make or break Reliance's digital bid may lie elsewhere. Let us go to Karan Taurani, an internet and new age firms analyst, to understand what that is.
If you look at Reliance, in terms of the recall they have created after Jio in the retail sector specifically, it has been very strong. Today, we're in a world wherein we are operating in an omni-channel market. Someone like a Reliance who was already established brand in terms of the brick and mortar model, I don't see any big concerns, for them scaling up online, except for one, clearly the user experience and the tech investment which go into the platform. Because I think that is something which gets the consumer connected to a particular platform, and if that is there, they can very much compete with the likes of Amazon and Flipkart. The customer today does not want too many apps. The customer is going to transition towards a super app or towards aggregators. This is something which Reliance is also planning to do right now, wherein they'll have pharmacy offerings, they'll have white goods, they'll have fashion, they'll have retail, they'll have jewelry. Investing into tech, investing into your marketing, kind of creating a brand, doing delivery, lead times being faster as compared to competitors, delivering the product in a proper manner. I think all these things are, go very well in terms of having a sticky customer base compared to a customer who's going to just come for discounting. And once the discounting goes away, he's going to go away from a platform. It's actually very tough, to get the customer move from one platform to the other, unless the other platform is offering something very compelling. So one would be, of course, the wide variety of products. Second measure would be, in terms of loyalty programs. And third, of course, would be the trustworthiness of that particular brand.
Reliance's scale and deep pockets lend confidence about its e-commerce ambitions. However, there's many a slip between the cup and the lip. At the end of the day, it really will boil down to beating Amazon and Flipkart at acquiring sticky users through superior experience. That last part remains the real challenge.
Stock of Reliance Retail has soared over 200% in the last 5 years, in tune with its growth during the period. Meanwhile, fears of a global recession have weighed heavily on domestic IT stocks this year, as investors remain bearish on these counters due to concerns that the US and European clients may slash their IT budgets. Do the sector valuations make them a contrarian bet? We tell in our next report.
IT shares have been among the worst performers on the bourses this year as hawkish global central banks continue to risk global growth prospects. Amid rapidly rising fears of a recession in the West, the Nifty IT index is down over 30% so far this year, as against a 2% cut in the Nifty benchmark index. Top losers from the IT index include Wipro, Tech Mahindra, Coforge, and Mphasis, which have corrected 39 to 44% during this period. While the near-term outlook remains volatile, analysts still see the sector as a good contrarian bet from a long-term perspective. This, they say, will be aided by cheaper valuations and the sharp depreciation of the rupee against the US dollar.
I think if you are looking at year or year and a half, that is about 12 to 18 months, then IT remains a preferred idea. The correction that we have seen is a healthy correction, 30% almost on the IT index. I think the valuations have become attractive. So if you have a long-term view of, say, about 12 to 18 months, then you can definitely look at IT. The only thing is, since markets are into consolidation mood, don't put all your money at one time. Buy some right now, maybe about 25, 30, 40%, and the balance you can go on adding on dips. So we remain positive on TCS, Infosys, HCL Tech and Tech Mahindra. In the mid-cap universe, we remain positive on L&T Technologies, Mindtree, Persistent Systems, KPIT Tech and Tata Electronics.
While some pressure could continue on IT companies' margins in the next few quarters, analysts expect this to improve by the next fiscal. This could be driven by reduced and/or frozen variable staff payments by companies to slash their employee costs. As per Elara Capital, the variable payout cuts hold the potential to lend material margin support. These can translate into operating margin support of 220 to 400 basis points for Infosys and Wipro. Further, consensus estimates have factored in an average EBIT margin improvement of around 80 bps in FY24 for large cap IT firms. Sharing a similar view, Apurva Prasad of HDFC Securities believes that the margins for the industry have bottomed out in Q1 FY23 amid moderation in attrition.
So we broadly have a constructive stance on the sector, and the positive view is also premised on some of the core verticals which are looking fairly okay, fairly strong in fact. So BFSI, despite all that's happening in macro, BFSI is looking fairly strong. So while there are macro risks which remain, but the commentary around deal timing, overall supply side related indicators, or if you look at some of the indicators from the most important partners, the large cloud platform companies, or some of the indicators from the large end clients of customers. Those remain very, very okay. So I think the demand should be resilient despite the macro uncertainty.
That said, markets may exhibit volatility today on account of the monthly F&O expiry and the street's reaction to the minutes of RBI's last meeting released on Wednesday.
After the IT stocks, let us shift our focus to government's plan to make India self-reliant. Mobile manufacturers recently assured the government that they will install Navik, a homegrown navigation system developed by ISRO, in new 5G devices starting January 1st, 2025. Navik is India's alternative to GPS. Let's find out more about it. The Global Positioning System, or GPS, has become entrenched in our daily life. Whether we want to maneuver traffic or find a restaurant, it has made our life easier. But did you ever wonder who owns the GPS or who runs it? Originally, Navstar GPS, the Global Positioning System, is a satellite-based radio navigation system owned by the US government, and the United States Space Force operates it. India has found its homegrown alternative to the GPS in the form of Navik. The government is taking rapid steps to enhance its adoption. Navik stands for Navigation with the Indian Constellation. It is an independent navigation satellite system developed by the Indian Space Research Organisation ISRO. Navik consists of 8 satellites and covers the entire India. Additionally, it covers up 1,500 kilometers from its boundaries. Navik was originally approved in 2006 with a $174 million budget. It was expected to be completed by late 2011, but it only became operational in 2018. Currently, Navik is being used to track public vehicles in India. It is also used to send emergency warnings alerts to fishermen venturing into the sea where there is no terrestrial network connectivity. Also, it is being used for tracking and providing information in case of natural disasters. Of late, the centre is pushing smartphone companies to adopt Navik in India. GPS provides global coverage, but Navik is currently limited to India and the adjacent areas. 3 more navigational systems offer global coverage, like the GPS. These are Galileo from the European Union, Russia-owned GLONASS, and China's Beidou. Japan's QZSS provides navigational coverage of Asia-Pacific with a specific focus on Japan. The government is aiming to remove foreign dependence on India's navigational requirements. It is more important in the case of strategic sectors. The centre believes that relying on GPS and others like it may not be wise for India as they are operated by defence agencies of their respective countries.
By the nation's trusted bank, SBI, the banker to every Indian.
Navik system is more accurate than GPS. It can offer an improved position accuracy of up to 20 meters. That is all for today. For more news, views and analysis, please log into business-standard.com. If you like this video, share it and subscribe to Business Standard. For more news, views and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram and LinkedIn.